Good morning, ladies and gentlemen. Well, we have a very exciting week coming up potentially with FOMC, ECB, and BOJ. We pretty much have the FOMC and the ECB a lock for a 25 basis point hike, and everything will then depend on what the guidance is, because we are really getting very close to potentially what will be the terminal rate in both yield curves, and then the fight starts between real yields and term premia. And I'd like you to understand what my thinking is and why I think that volatility here is going to be very low or relatively low in bonds until and unless we get a definitive answer as to what the economy is doing and will it slow or not. Now, on Friday, we had an absolutely fantastic thread from David Cervantes of Pinebrook Capital. I've included a link to it in the Word document that comes with the video. Please go and read it now and then come back and watch the rest of the video, because I'm going to be referring to it throughout the bond analysis. So it's important that you read it. He's put it in a much better way and much more concisely than I am able to, and that's why I have huge respect for David and agree with every single word he's written here. Now that hopefully you've read his tweet, you will see what the dichotomy or trichotomy here is. Five-year forward inflation expectation rates are basically stuck between 2.1, 2.2% and 2.5%, while the 10-year break-evens are stuck around this 2.5, 2.3, 2.5 area. And then you have the real rates basically stuck around 153, 155. This situation is, I won't say untenable, but I will say that in the short term, it provides no answer to where yields should go. People are probably overpaying for 10-year notes and 30-year notes, and really we won't get the answer till we get the QRA in early August. I think it's August the 2nd, and we know what the issuance is going to be. If we get a shift from bills into long-term notes, we will find out. I think that there is very little likelihood that the bond market overall rallies, and I think that we get some kind of a bear steepening move in the yield curve. Let me try to explain that even in more detail. The dot plots said 2 hikes. Fine, the market went to 2 hikes and then came back to 1 hike. I think that is more likely than not to remain the situation in the short end of the curve. So on Wednesday we get the 1 hike, and then what we will be doing in the short end, in say 2s and 5s, is arguing about the probabilities of getting to the 2nd hike. I think the probabilities of getting to the 2nd hike, or the market discounting the 2nd hike without very strong economic data, are no more than 50-50. And therefore we will be trading around 12 basis points more. On really good days, you'll be at 8, and on really bad days, you'll be at 16 basis points. So we will be trading at the very short end around the 12 basis points mark of, of more hiking. And I will show you what that means for the 1 year, for the 2 year, for the 3 year, for the 5 year. The real decider about what the yield curve does and what long-term yields do, i.e. 10s and 30s, as David Cervantes put it in his tweet, will come A, from the issuance, and B, how fast the market gives up on the idea that we are going to have a recession in late 2023 or early 2024, when the market has penciled in a huge amount of rate cuts from the Fed. Let's go into more details about what I expect to happen at the very short end. And here we're talking about the U23 and Z23. U23 basically is going to go out somewhere between 94.50 and 94.65. You will get a compression in trading here, and it's the Z23 as well, which is going to go much the same as the U23, as the market battles between the 1 hike and the 2 hikes. For the foreseeable future, I just can't see that the market is going to decide one way or the other. And as I said, I think we will be trading around the 12 basis points, i.e. a 50% probability that it happens by the next Fed meeting, which is in September. So for the foreseeable future, U23 and Z23 are going to be absolutely dead, and the volatility of them is going to come in and come in and come in. Now, what is going to happen to the late 24s? And let's have a look at something like Z24. With each number that comes out and shows that the economy is strong, this has to go down. You can see that we have, 140 basis points of cuts priced in between now and December next year. With every data point that shows the economy and unemployment not coming down, especially unemployment, this differential has to come in. And we will be discounting less and less and less. 140 basis points is basically 3 full 50 basis point cuts in 2024. Unless the economy starts rolling over, this has to come in. And the yield curve at the short end basically has to flatten in this case, and the effect on the bond market is going to be quite pronounced around the 5-year and 10-year areas, i.e. the term Premia has to be taken out of and go to the negative term Premia and has to go towards 0, because we will be expecting less and less cuts. That is what my head is telling me. And now let's have a look at the individual tenures. The shorter you go, and this is the 3-month, the less volatility you can see. And that is precisely what I was saying. The volatility at the very short end is going to diminish simply because we will be stuck at this 50% probability, which will vary a little bit day to day, of the Fed doing the second hike. So the 3 months, you can see we haven't really moved in 2 months. The 1 year, we haven't really moved in, since, what is this, late May. And 2 year, because it's composed of the various segments of 2024 that we spoke about, is the one that is probably, slightly going up. This is the same period in late May right here, and look where we are now. We are 40 basis points higher. The likelihood is that the 2 year just cannot come down much more than 475, and that slowly, unless the data says something to the contrary, it goes back up towards this 499 area, where I don't see it really going through. But the move is going to be a continuation of this move higher. As what happens to the 5s, 10s, and 30s, that will depend on the QRA, which comes in early August. How much issuance is there going to be? Can term premia go back towards zero? Yes, it can. I'm beginning to think that we get the same kind of move as we get in the 2s, i.e. up here and stay here, in the 5s, but the 5s have got more room to go towards this 440, 450. The 10s have got, even more room to go up towards the top, and the 30s, 405, 419. It's going to be that kind of a move that with every number that it doesn't show economic weakness, term premia, I think, are going to, the negative term premia are going to be taken out, and the bond market slowly bleeds. And then what happens? You get some kind, at some stage, when the short end can really not move anymore, then you need to see the bear steepening of the curve. Where is the bear steepening? When it comes, if it comes, be seen. Well, it'll be seen in the 2s 10s and 2s 30s. So that is where we have to concentrate our technical analysis. Because if the 2s get to a level whereby the volatility of them is very low, the volatility then, if we get the issuance that we expect from the QRA announcement, you are looking at the 10s and 30s to do the move, while the 2s do very little indeed, i.e. almost the mirror opposite of what has been happening for the past year, let's say, or even more. Certainly throughout 2022 and so far this year. So you're looking for levels where 2s 10s might stop out and give some kind of a reversal signal. And here it is, it's basically 108, and we're very close to it. But I'm giving you a framework here to think about how the bond market is going to behave. If the 2s, as I said, are going to get to a level where they no longer move, or where the moves are a couple of basis points per day, then the volatility must transfer somewhere else. And that somewhere else can only be the 10s and the 30s. So if we look at the 2s 30s, this is already giving you an advance warning that the market is beginning to think this way. The fact that we can't go back above the levels that we were in September of 2022, and that the market is rolling over in the long term, tells you something. So you're looking for around the 20 to 25 area in 2s 30s to start looking, putting on positions where the market will actually roll over and go back towards zero. So I think I have in my mind a playbook for the next 2 or 3 months. And now it's just a question of, does the data basically validate that? And I think that with every single data point that comes out and that shows that the economy is not rolling over, that unemployment is not rolling over, rather that employment is not rolling over, and that consumption remains robust, and that inflation is basically on the same track that the Fed expects, but it's sticky. And the fact is that inflation expectations are just not going to 2%, but they're staying above 2%, will mean that the Fed will, while still fighting this dichotomy of is it going to be one hike or two hikes, which doesn't really matter at the end of the day because we're already at one hike and then we might get another 10 basis points. But that is nothing compared to what the long end can do if the issuance is transferred to the long end and people start giving up on the negative term premia. That can go 30, 40, 50 basis points without any problem. And from somewhere around here, we could find ourselves down here in, without any problem at all and without anything having happened. Just time and data not supporting an immediate turn in the economy. I'm not going to show you the German yield curve because there absolutely nothing is happening. But what I want to show you is the differentials. And now here I am beginning to change my opinion. As you know, from over here, I've been extremely bearish and looking for these differentials to come in. Now I'm beginning to think that these differentials will go back up. Why? A, because of the difference in issuance between Germany and the US, and also because the economy in the EU in general is that much weaker than the US economy. So all the arguments that I had for this move down are beginning to disappear, and the magical time that we will get a real answer, do these go back up towards, or even through 152 towards 172, is going to be when we've seen the QRA in August. I don't think next week is going to be it because both are going to hike, and therefore this should remain tight, or even the twos should remain tight. But as time goes on, I think the likelihood of fives and tens, say 5s going back up towards 174, and tens going through 152 up towards 165 to 172, those odds are increasing. Could this be an inverse head and shoulders? Absolutely. Another couple of weeks are going this way and then start trending up. That all depends on the previous analysis that I gave you. Does it make sense? Does the data support it? And the analysis really that we are looking for is the US analysis, because I think the volatility in the EU is going to be even less. And therefore it's going to be the US that drives it, not the EU. i.e., I'm not looking for higher yields, i.e. the drip of higher yields in Germany. I'm looking for it in the US. And therefore the spread comes out by the US moving and not Germany. If I'm correct in my analysis of bonds, then you can't really be bearish of DXY. You're going to have a situation in which the Fed is getting towards terminal, but so is the EU. So I really can't see that you're going to get much impulsion in the short term down in DXY. And if I'm right that the differentials eventually, because of the issuance, start going up, then that will put upward pressure on DXY. Now, how likely is it to break this 102.82 level in the short term? I think it's very unlikely. But also you saw what happened last week. The differentials moved a little bit in the favor of the US. But what the market is saying down here is that it's uncomfortable selling dollars. It'll need the dollars to buy all the bonds that are going to be issued. And really, the fact that the Bank of Japan is going to be lagging so far behind the Fed is also an indication that, you know, the dollar is not that unattractive at these lower levels below par. So what I expect for the next week or so is sideways action. But then eventually I expect definitely a move back up, probably above the 200-day, moving average. I just can't get bearish of the dollar at these levels is the answer. I just think that selling it down here is a very silly thing to do in terms of risk reward, because if I'm right in my bond analysis and long-term yields start turning up, I think the dollar starts looking very attractive against everything. Now, there's a definite dichotomy building here between the Euro USD and the Japanese yen. So if we look at what is happening here, you will see that the euro is really very unlikely, as I showed you, I mean, in the DXY chart, because DXY is nearly 60% the euro. It's very unlikely to come crashing down, right? I mean, this chart is still supportive, and you're looking for minor moves in the euro. But if we look now at the yen, you will see quite the opposite. It basically tested the 200-day moving average. It's still sloping slightly down, which says there'll be support at this 137 level. But slowly this is turning, and it's very evident on the weeklies that it's holding the support. Now, let's look forward to what the market could do in the medium term here. If I'm correct in the bond analysis, and you get this drip of basically a bear flattening of the curve, and the yields keep on going up, there's going to be more and more pressure on the Japanese to actually start doing something themselves with their yield curve control, or with some form of tightening of their very, very loose economic policy. And Wader himself at Sintra said that he wants to wait. Therefore, I expect the Bank of Japan to do nothing now. But he's waiting for confirmation. Okay, he's not waiting to cut yields. He's waiting to tighten. And he could easily get that signal sometime at year end and sometime in the first quarter of next year. But what is interesting to me is, what is the market likely to do before then? It's likely to put on pressure on Wader to do something, i.e. it's likely to go and trade at 150 to put pressure on him to tighten. And that could be so I showed you the euro, I've showed you the yen. I think the euro-yen cross is the one that's going to take the strain for a while, with the yen remaining weak, the euro remaining relatively strong, and the market putting pressure on Wader to tighten. Now, what is likely to happen to the bonds if the market, US bonds, if the market is expecting or trying to force Wader to hike or abandon yield curve control or tighten? Imagine what that's going to do to the long end of the bonds in the US. It's not going to be pretty, right? It's really not going to be pretty. You could get a very pronounced bear steepening of the curve, with the twos doing very little, but the tens and thirties really getting whacked. And here is euro against the Japanese yen. It looks as bullish as hell, doesn't it? I think that any kind of a dip is a buy, and this is going to be a continuing theme because the market will try to pressurize the yen and therefore Wader to do something and abandon his yield curve control or tighten in any way. And therefore, I think that that is another reason for for basically the steepening of the curve in the longer term, not in the short term. And this is nothing that I've said today is going to happen in the next week or two. But I'm just trying to give you a framework of how to think about the next quarter. And from August the 2nd, when the QRA is announced onwards, this to me is likely to be a theme if we switch issuance from the short end to the longer end and if the data in the US remains strong. Now, you know that I like to triangulate everything, and I keep on asking myself, why is gold so stuck in such a narrow range? And it could be that it's because the dollar's going to go nowhere. As I showed you, it's going to be stuck between the euro and the yen, as it were. And bond yields are not going to go down, but slowly they're going to start going up. In which case, the upside in gold is very, very limited. And we keep on getting, we keep on staying above the 200-day moving average, but it just keeps on going up with less and less impulsion. If you now then look at what DBC is doing, it's showing signs of life, but it's still below this 24.39, and gold against DBC keeps on bleeding down. I think this is this is going to remain the situation for the next week or so. So there's nothing that we have to decide at the moment. What we have to decide about is DBC going to break 24.39? Because if it does, over time, it's going to trade up here. It's going to trade at 26.93. And that is going to put even more pressure on bonds. And therefore, this relationship actually worsens and goes down to these levels around 670. So we're going to have to decide in the next 2 or 3 weeks if commodities are turning up. And you will remember on Tuesday or Wednesday, we had that JP Morgan piece about it's a good time to start buying commodities. I don't know. I'm not sure. Technically, I think we still have time. But if we start looking at oil, it is knocking on the door of the 200-day moving average. And, if it starts closing above here, and if it starts turning the 200-day moving average, you could easily get a spike up to 97, and that definitely gives you a steepener, a bear steepener in the US in yields. And there you have it. You're looking for higher yields. You're looking for higher oil. gold can't really go anywhere in that kind of an environment. So it's going to be interesting. I think a lot of people are going to get very badly buried in the in the latter part of the year after this QRA announcement, and with this battle going on between real yields and the term premium. Copper is actually giving you a pretty good risk reward kind of play. Any kind of a dip towards the 200-day moving average and this level around the 367, 370 level is an opportunity to have a very good risk reward play insofar as you buy that dip, and any kind of a weekly close below the 200-day moving average, you know that this isn't going to be a great play. And basically that's the way to play it. You buy a dip below it and you hope that you get the close above and a reaction back up towards this 417 area. If it starts closing below this line, this 367, then really the move is not going to be impulsive, and you might as well just give up. But the first try, I think it's a definite buy. Any which way you cut it, for me, what happened last week in equities is the Dow Jones and its spread relationship to everything else. I showed you for weeks now the Dow Jones monthly. It's broken, and this is the reaction you get in the Dow against the SPY. I think it goes to this level, 79, let's call it. So it's got a few more percentage points. Against the NDX, this is the volume bar rather than a retracement. I think it can easily go and fill this gap to around these kind of levels, 24. So that's a long way against the Japanese EWJ. I think it can easily go to this kind of level. And don't forget the Nikkei is a very strong market. And also that we are looking for yen weakness. And that, what does that say? Well, that says that the Nikkei isn't going to be weak, therefore you're looking for strength in the Dow. And finally, the Dow against VTI, which is the totality of the stock market. This a 0.382 retracement of this comes here, 158. So that really should not be surprising. 157 is the absolute minimum that I see it. So, you have more room in the Dow on a spread against everything else. And if we look at the Dow against the FEZ, which is the Europe, I think that can easily trade up here at 7.87, which is worth having. That's in percentage terms, that's a decent sized move, and therefore I think the Dow should be your favored long, and many others that I've just shown you can be spread against it. Finally, as you know, we get something like 50% by weight of SPY reporting this week. What would make sense is that we get a buy the rumor, sell the fact kind of event. We have anticipated very decent earnings, and therefore the market is more likely than not to have that kind of buy the rumor, sell the fact effect. And don't forget that the Dow Jones has very much less by weight of those names that are reporting, the Apples, the Metas, the Googles, etc., etc. So it would make sense that the Dow Jones outperforms on that kind of an event. Now, whether the market is front running that or not remains to be seen, but I certainly think that the likelihood of us trading up here around 79 on earnings and because of earnings is far greater than not. And here is that Dow monthly chart, and you can see why this 34,600 level is so important. Now, what you have to ask yourselves is, why would the market be doing this now? And you can see where, the technical levels would be somewhere around, the all-time highs. Here, where the monthly Bollinger Band is. Look at the composition of the Dow stocks and look at the compositions of NDX, right? The Dow stocks are much lower beta. Lots of financials there which like higher interest rates. So that's another point of triangulation which tells you that eventually you get this bear steepening. Is it a cinch? No, it's not. But it's yet another indication. The fact that commodities are strong, the fact that oil is getting stronger or not weaker, whichever way you prefer to look at it, the fact that the Dow is breaking out and that it's on a tear against, or at least a retracement, a sizable retracement against the previous leaders like NDX, has to lead you to the opinion that the bond market is basically saying that yields are going to stay high and go higher at the long end, but not at the short end. To me, this is all triangulating. Compare the Dow chart to the NDX, and you can see how there's definitely been rotation out of NDX into the Dow stocks. Where is the support? Well, its support is around the 15,000 area. The fact that the Dow has broken up indicates to me that the retracements in the NDX are going to be, I'm not going to say small because they could easily be 3, 4, 5 percentage points, but they're going to be limited to that kind of move. Because eventually, if the Dow has to get to 36,000, could it get to 36,000 with the Dow with the NDX being somewhere here? Absolutely, it could. I.e., that the NDX does nothing for months and the Dow rallies. That's perfectly possible. But I definitely think that there is rotation. There will continue to be rotation, and the Dow is your favored long. To me, the Nikkei is not really doing anything wrong. And this is just simple consolidation on the dailies, and like an ABC. It will do something wrong if it now starts breaking down below 31,900. That would be my sort of... I really don't expect it to do that. Because why? Because I think the yen is going to remain weak and therefore support the Nikkei. So, and also I'm not looking for such a huge retracement in NDX or in the SPY, and especially not in the Dow. Therefore, I would be very surprised if this breaks down. But we're getting a very good risk-reward level here at around this 31,850 to 900 area. You buy it first time round, and if it closes through there, well, it starts looking a bit, deeper. ABC probably will go all the way down to 31,000, so you don't want to stick around, you want to pick a better level later. But first time round, I think the risk reward around this 31,850 to 31,900 is pretty good. Finally, I wanted to show you the transports as well, because they are confirming the Dow breakout. So this is the Dow Jones Industrials and this is the transports. As you can see, this is very much a confirmation. Are they very overbought? Yes. Could they come down a little bit, spend 2 or 3 weeks going sideways? But this is definitely a confirmation of the breakout in the Dow. And as long as transports are this strong, I can't see the industrials not being strong too. But what does that tell you about what bonds are doing? Okay, it just another nail in this. We are going to get a very quick recession very quickly. It's just not going to happen. Or these markets are basically saying that this is not going to happen. We need to see a massive retracement in these to even start considering the possibility of a recession anytime soon. And if that doesn't happen, as I showed you in the Eurodollar charts, the 2024s need to start bleeding. The SOFR 2024s have to bleed. And probably a butterfly of 2023s, 2024s, short 2024s and long 23s and 25s is probably the way to go there, because every other chart is confirming the fact that once we get to this battle of where the absolute terminal is, the very short end is going to be absolutely stuck within a few basis points, and then the pressure has to come at the longer end. That's the only thing that makes sense at the moment. Now, data can change it, but at the moment, that is the only thing which makes sense and the only thing that the market is actually confirming by triangulation. And finally, on to the buyer sheet. Gold not excited, DBC looking to buy, DXY looking to buy dips, especially in the euro yen. So here the only thing in equities that I like is the Dow. And I will tweet you high risk reward levels as of Monday. And then you can spread them or you can hold them outright for a bit, whichever way you decide. I prefer the spreads. I think the Dow will remain strong, at least for the next month or so. And it's going to drift upwards, certainly against on a spread and on an outright. That's all I've got for you. I'll tweet you on Monday. Have a wonderful weekend.